I'm Naomi Domingo. It's Tuesday, April 8th, 2025, just after 6:10 a.m. here on the East Coast. The opening bell on Wall Street is still a few hours away, but already we're seeing a complex picture emerge from global markets and the latest economic data. Let's start with the overnight session in Asia. It was a decidedly mixed bag. Tokyo's Nikkei 225 managed to eke out a small gain, closing up about 0.3%, buoyed perhaps by some stability in the yen. However, markets in Hong Kong and Shanghai faced headwinds. The Hang Seng Index slipped around 0.6%, while the Shanghai Composite was down closer to 0.4%. Concerns about ongoing property sector issues in China seem to weigh on sentiment there. Across the Atlantic, European markets opened just a short while ago and are currently trading cautiously. London's FTSE 100 is hovering near flat, the German DAX is down slightly, perhaps 0.2%, and the CAC 40 in Paris is showing similar modest losses. There isn't one single driver, more a sense of digestion after recent moves and perhaps some apprehension ahead of key inflation data expected later this week from several major economies, including our own. So, what does this mean for the U.S. Open later today? Well, futures markets are providing some clues. As of this moment, S&P 500 futures are pointing slightly lower, down about 0.15%. Dow Jones futures are indicating a similar fractional dip, while Nasdaq futures are also suggesting a slightly negative start, perhaps down 0.2%. It's not signaling a major sell-off, but rather a continuation of the cautious tone we're seeing globally. Now let's look at the U.S. economy itself. The macro picture remains, well, interesting. Growth, as measured by the most recent GDP figures, has shown resilience, certainly stronger than many predicted 6 months ago. The labor market continues to be a pillar of strength. The unemployment rate is still historically low, hovering around 3.8% in the last report, and wage growth, while moderating slightly, remains solid, supporting consumer spending. However, the inflation story is where the complexity lies. While we've seen significant progress from the peaks, the final mile in getting inflation back to the Federal Reserve's 2% target is proving sticky. Recent CPI and PCE readings showed inflation ticking along slightly higher than anticipated, particularly in services. This keeps the Fed in a data-dependent mode, and while the market largely expects rate cuts later this year, the timing and magnitude remain subjects of intense debate. From a more Keynesian perspective, you could argue that sustained demand, fueled by that strong labor market, is contributing to this persistence, requiring the Fed to maintain its cautious stance for longer. On the micro level, we're heading into the early stages of the next corporate earnings season. Initial reports will be scrutinized for insights into profit margins, forward guidance, and how companies are navigating input costs and consumer demand. Any surprises here, positive or negative, could certainly sway market sentiment. We also saw some data last week suggesting business investment is holding up reasonably well, a positive sign for underlying economic strength. So, pulling it all together, the mixed overseas sessions and the slightly negative tilt in futures, expect a cautious, perhaps slightly lower, open. Investors will likely be watching energy prices, which have seen some volatility recently, and keeping a close eye on any early earnings whispers or pre-market news. The broader narrative remains a tug-of-war between a resilient economy and persistent inflation, with Fed policy expectations hanging in the balance. It's a market looking for clear direction, and today might start as a wait-and-see session.
Hi, I'm Stu Norcat, and thanks for watching Constructive News. Subscribe to get regular updates about the most important news stories, and we thank you for watching.